as you've been highlighting, in your most recent discussion, the opportunity set, while COVID was going on, was really associated with technology, right? And technology was a defensive asset. It did extraordinarily well. In fact, it saved a lot of lives and brought us a lot of convenience. As we come out of COVID, there's a lot of factors to suggest we're going to have a rotation, back into the cyclical stocks, back into emerging markets, back into Southeast Asia, back into small and medium-sized companies, because COVID created an enormous market anomaly between what I would describe as stay-at-home and leave-your-home stocks. And that would be true in any case. But there are some other factors that are also very interesting for investors at this point as well, and we highlighted some of those.
So does that suggest then that technology stocks there's technology and then there's technology, and they're the stay-at-home parts of technology, whether it's Apple Computer or Zoom
right.
or Microsoft with Teams and so on and so forth. There are those stocks, and then there are others. There's the chip makers and lots of things. Does that suggest, though, that these stay-at-home stocks are going to have relative underperformance vis-a-vis some of those other cyclicals that you mentioned, whether it's financials, industrials, materials, et cetera?
Right. So what you're saying is also important, right? For technology leaders, companies that provide services that are going to have sustained growth, 20, 30% a year for many, many years to come, those companies are going to do just fine. But not all of the tech stocks in the NASDAQ fall into that category at all. And a lot of them got hyperinflated as a result of the moment we're in and what's happened, for example, for software as a service stocks. So I do think that our clients are going to do better and generate alpha over the next 12 to 18 months by focusing on the leave-your-home stocks, everything from retail, to travel, to restaurants and things like that. But even banks and financials, right, which are going to benefit when we come out of COVID, are going to be large beneficiaries of this trend, and dividend stocks as well. And so the Citi Private Bank is now overweight 10% equities in all of those kind of stocks, but we are keeping, to your point, an exposure to technology. And so I think this is a great time for investors to earn alpha by shifting their portfolios, right, to these leave-your-home stocks.
To the leave-your-home stocks. And those mean hospitality stocks. Those mean, I assume, airlines, cruise lines. What else?
So certain financial services companies, the major banks all around the world, small and medium-sized stocks, ex-U.S., and some emerging markets, including Mexico, Brazil, and Southeast Asia. That's not the whole story. As you said at the outset, the other part of it is think about what's going to happen. We've got financial repression, meaning low interest rates for a very long period of time in order to manage the outstanding debt that we've taken on, which is globally $10 trillion. We have enormous amounts of fiscal spending, some of which is still forthcoming. And then we have what I describe as the dishwasher syndrome, which is if you want to buy a cheap dishwasher today, you can't. Right now, the supply chain is empty. You can buy the expensive dishwasher, but I went online for my family and tried to buy pajamas. I tried to buy my brother a monitor, a certain kind of monitor. Things are sold out. And so you're going to see 14 months of production in the next 12 months once COVID begins to leave as the supply chain and inventories rebuild. So it's going to be quite a robust recovery that we see ahead of us.
Shepard Smith here. Thanks for watching CNBC on YouTube.